bonds are woefully mispriced. Yields need to be much higher. Prices need to be much lower. Stocks are overpriced. Their multiples are too high. The US dollar is dramatically overpriced because it's going to lose a tremendous amount of its purchasing power over time, and therefore it should have a much lower exchange rate than the one it has right now. It also means that gold and silver prices are much too low, because right now gold is priced for a world where there is no inflation, where inflation has been vanquished by a tough Federal Reserve that is committed to ridding the economy of inflation. When the markets realize that that's not the case, that the Fed is going to choose inflation as the lesser evil, because that's the choice. Do we have a massive economic collapse, financial crisis, depression, waves of defaults and bankruptcies, or do we tolerate higher inflation? The Fed already made that deal with the devil, and it's going to keep its commitments. We're going to have higher inflation. The markets just need to come to terms with that and price it into assets. And of course, it also means a huge decline in the American standard of living, because I think the recognition of this reality is going to be the final nail in the dollar's coffin. It's going to cause it to lose its status as the world's reserve currency. And so Americans are not going to be able to exchange the money that we print for the goods everybody else produces. We're going to have to live within our means. And those means have been greatly diminished during the years that we've been able to run these massive trade deficits and outsource all of our manufacturing. We've gotten a small taste of those supply channel bottlenecks recently. Well, we're going to get a full helping of it later once the dollar plunges and we really see how much we depend on global supply chains. But again, to wrap this up, when it comes to individual investors, right, we need to take advantage of this situation. You know, I have been preparing and helping my clients prepare for this for over a decade. And the only thing that surprised me is that we've been able to kick the can down the road for as many years as we have. But everything else that's happened is what I predicted. It's just taking place on a longer time scale than I would have imagined over a decade ago. But be that as it may, we're here. And the fact that we were able to kick the can down the road for as many years as we did just made the problems much worse. The bubble has grown much larger during the years of can kicking. And as a result, the collapse is much greater. It means that investors stand to lose a lot more purchasing power if they don't understand what's going to happen and modify their portfolios to account for this. And it also means that the investors who do make those changes are going to make even greater profits, I believe, as a result, because the bigger the bubble, the more air there is to come out. And the more air that comes out of the bubble, I think the more profits that the people make who bet against that bubble. And so that's what we're doing at Europe Pacific Asset Management with our strategies. But I think for people who want to speculate and who are willing to assume a higher degree of risk, and that's always the case when you're investing in gold and silver mining companies, I think those assets are among the most mispriced assets in the market, because if inflation drives the price of gold up to 5,000 or 10,000, the markets currently assume that the price of gold is going to stay at 1,800 or lower into the indefinite future. I think the markets are wrong. But more importantly, not only will a much higher price of gold relative to the cost of mining it really help earnings of these gold mining companies, but it's going to cause a lot of gold that markets currently assign a zero value to all of a sudden have incredible value. Because if a gold mining company has gold and it costs $2,000 to get that gold out of the ground, and you don't think the price is going above 1,800, that gold is worthless. It costs more to mine it than you can get by selling it. But that whole dynamic changes. What if the price of gold goes up to 5,000 and the cost of mining it goes up to 3,000? You know, now you have $2,000 value for every ounce in the ground, and now that value is now going to be factored in to the price of these stocks. So I think you have tremendous opportunity in that segment of the market. For those of you who don't want to take as much risk I think you can also protect yourself with our other investment strategies that invest in value-oriented companies outside the United States, companies that pay good dividends, companies that sell products and provide services that people need. You know, inflation is a problem worldwide. The Fed isn't the only central bank that kept interest rates too low or printed too much money. So when you own a business, you want to own businesses that provide products and services that people need so that you have pricing power to raise your prices as your costs are going up. You don't want to be in the business of providing items that people just buy after they finish paying for all the stuff they need. You want to sell necessities, not luxuries. The discretionary items are the ones that are in trouble, because as people pay more money for food or more money for energy and things like that, they're going to have to cut back on other things. And so you don't necessarily want to own stock in those companies, because they're going to be facing a lot of economic headwinds in addition to just higher interest rates and rising inflation. So we are making these calculations when it comes to determining our allocations and the companies we buy. Specifically, all the companies we're buying are designed to thrive in an environment where the US economy is weak, where we have stagflation, where we have high inflation and a weak economy in the US. And I believe that when the dollar finally tanks on this reality, that is going to set off an economic boom outside the United States, particularly in the emerging markets, because those economies have suffered from an overvalued dollar. They are going to experience relief when the dollar is no longer overvalued. And in fact, I think there's going to be big inflows of capital into these economies that is really going to provide a big boost to their economy, and therefore provide a significant increase to the asset values in those economies. I actually do have an emerging market fund that people can invest in, specifically to take advantage of the repricing of emerging market assets, not just the stocks, but the currencies that those stocks are denominated in. Because as the US dollar falls, I think it's the currencies of those countries that are going to rise. In addition, you know, I would encourage the people who are listening to my presentation to continue to follow what I have to say about the markets on a regular basis. I provide my insights generally at least twice a week, sometimes more, on my podcast.